Talk a little bit more about where Canada's economy is headed with Royce Mendes, who's been digging into the data. He's managing director and head of macro strategy at Desjardins. Good to see you, Royce.
Good to see you as well.
So right now, the stock market seems to be in a good mood, and everybody's talking about rate cuts, and there's some euphoria out there. And yet, I think whenever there is a shift to cutting interest rates, you're trying to figure out what the reason for that is, and are we going to have to ramp up, as Rosenberg is suggesting, on the rate cut front because our economy is really starting to collapse. What is your take right now?
Look, Dave could be right that at some point in the future we may have to increase the speed or magnitude of rate cuts. But at this point, right now, we're not in a recession. I know some people are using the term GDP per capita recession or vibe session. These are unhelpful. They're mischaracterizations of what we're facing. A recession has a very specific definition, and we're not in that. One clue is the fact that we're not seeing massive job losses. You can see that in the job separation rate. What it measures is how many people who were employed last month are no longer working this month. That rate is still very low. Typically, in a recession, you'd expect to see a lot of people losing jobs. The reason the unemployment rate has risen is because in this cycle, despite the fact that we have had job gains pretty consistent over the past year or so, they haven't kept up with population growth. So all of the new people that are coming to Canada, all of the newly landed immigrants, they're not finding work as quickly as they were previously. New students who are graduating high school, college, university, they're not finding work. The key here is that if you're new to the labor market, it's a tough slog. If you are in a job right now, you're not really at that much risk of losing your job. That is very different than a recession. I can tell you, people who are saying we're in a recession right now will feel a lot more pain if we were actually to fall into a real textbook definition a few months or quarters from now. It will feel very different. It will feel far more painful.
And what is what are the cost realities for those two groups? So as you mentioned, you've got a growing cohort of both new Canadians and maybe younger Canadians new to the workforce that haven't been able to find substantial work. The people who are employed, we keep talking about the mortgage renewal process. If you were to see changes in the dynamic of those people who have been able to keep a job, even if companies aren't hiring like crazy right now, are those the people that would primarily be dealing with, higher interest rate costs through their mortgages, or how does that work?
The good news here on the mortgage renewal front is that the people who tend to have mortgages and large mortgages are the ones that are currently employed. They were probably employed previously. That's how they got the mortgage. That's how they qualified for the mortgage and passed the stress test. And right now, they're probably still employed. Where we're finding it tougher, where people are finding it very difficult, is if they are coming to Canada, they're facing the reality of very high prices, particularly house prices and rent prices, and they're not able to find work right away. That's why you see in some of this survey data that the results are so sour, is because there's a lot of people in this situation. But that's not characteristic of a recession. That's characteristic of very rapid population growth with the economy operating in sort of a weak state. It's not doing great. By no means is Canada's economy doing great, but we're not in a recession, at least not yet.
Okay. Now, when it comes to what the Bank of Canada ultimately does, because we kicked off the conversation around that theme, what are they going to be watching? Sounds like you're still, you've told us in the past, you're in the camp of people who think they are going to be cutting rates as we roll along here, but maybe less aggressively than somebody like David Rosenberg might think right now. Give us a sense on how you're going to be watching the data roll in here.
Yeah, I think there's two camps right now that are mischaracterizing the current environment. One is the camp that's saying that we're already in a recession. I don't believe we're already in a recession. I think there's still a narrow path to a soft landing. The other camp is questioning why the Bank of Canada is cutting interest rates at all if we're not in a recession. Well, the reason we're cutting interest rates right now is because we know what's coming. That mortgage renewal wall is going to hit, whether we like it or not, in early 2025. And what we've been saying for so long is the Bank of Canada needs to get rates lower before that point so that people renewing after that are doing so in an interest rate environment that is simply more manageable. We are calling for a total of about 275 basis points worth of rate cuts during this rate cutting cycle. Now, typically in a recession, you would expect interest rates to fall by 400 to 500 basis points. That could still happen if, unfortunately, we do fall into recession and the downside risks materialize. But right now, we're somewhere in between. And that's what markets and businesses care about. You know, I think that the word recession gets a lot of, you know, it creates a lot of emotions in people and it gets a lot of attention. But what businesses and markets care about is the reality. And the reality of the situation right now is that Canada is, for now, avoiding that R word.